The Federal Reserve is responding to a very good economy, right? So the chair indicated last week to the markets that he sees upside risk to growth. And so the Fed is reevaluating publicly what they would see would be their neutral Fed funds rate. That might not be their terminal Fed funds rate, which they have pegged at around 3.5%, but 3% is what they had set the market up for as this neutral rate, this rate that lets the economy continue to grow without inflationary pressures. They're having a public discussion as to whether or not that is appropriate or not. And if they do come out on the upside of growth being stronger than expected, we would expect the Fed to continue moving beyond 3%, which is what the market has priced in June.
So funds have basically performed this year, it seems to me, bond funds that is, the way you would expect them to. The shorter the bond fund in duration, the lesser the loss, the longer the bond fund's duration, the greater the loss. As we move into 2019, where should investors be concentrating their fixed income dollars? Is it at the shorter end?
If it's solely a fixed income investor, we definitely advocate shortening duration and going up in credit quality. However, you know, bonds act as a diversifier to a broader equity portfolio. And your previous commentator mentioned that. And so we think there's a place for bonds of all durations depending on the underlying portfolio. But if you're just a fixed income investor, we have seen investors shorten up duration. You know, money market funds are yielding over 2.25%. So cash is finally worth something. And if the Fed continues to raise interest rates, we wouldn't expect that trend to do anything but continue.
What have the flows been like, Gemma, in the month of October as volatility has really picked up in the stock side of the equation?
You know, Vanguard's flows year to date continue to be relatively good, although down from the previous year. Active management and fixed income at Vanguard is about 50% of the overall assets. And so our flows tend to be continue to be positive. What we see in my funds, I see investors moving around, shifting their allocation and the duration exposure to wherever they're comfortable. We have investors who are barbelling between cash on the long end, intermediates, and short interest rates. And so we expect investors to continue to respond to the Federal Reserve move. Our forecast is 3% before they pause and assess. But if we're wrong, it's because inflation is running faster. And the inflows into the inflation-protected securities funds across the industry continue to reflect investors buying inflation protection.
Do you see, there's been a lot of talk about the so-called neutral rate for the Fed and seeking that neutral rate. Do I infer from what you just said that you think 3% is roughly that neutral rate?
Yeah, we do. I mean, long-term, a real Fed funds rate, so a nominal funds rate less inflation of around 2% will give you 1%. That has proven to be a very restrictive level. We don't forecast core inflation pressures by the Fed's core PCE metric to be much above 2.3%. So right around 3.25%, we think the Fed is starting to hit neutral.